I'm Janessa Howarth. I'm a partner in our deal advisory and strategy practice here at KPMG. I want to welcome all of you to our panel, our growth in M&A in a volatile market. We're excited to have all of you joining us today, and we have 5 esteemed panelists with us to provide their perspectives on how they've weathered the last year and how it's been different from other economic crises. Certainly, it's been a very difficult road from a health crisis perspective. But as we sit here fresh off of Thanksgiving, we have a lot to be thankful for. And for all of us speaking today, I think we can all agree that the market bouncing back quicker than expectations and the surge in the M&A deal volume activity since the late summer have both been 2 bright spots. So with that, let's get started. Today, we have Judith Crawford, the incoming CEO of Beacon Mobility starting in January. Ilona Florence, the SVP of Corporate Development at C&S Wholesale. Matt Hines, Senior Managing Director at Aon Transaction Solutions. Fred Heller, the VP of Corporate Development at Nuance Communications. And Jeremy Segal, the SVP of Corporate Development at Progress Software. So we're going to start today by having each of our panelists provide a brief intro with some initial comments on the topic. And all right, let's start it off with Judith.
Hi there, thanks Janessa. And despite my Scottish accent, I am based full-time in the US. Originally started at KPMG, and I'm in quite an interesting role at the moment because I'm transitioning between 2 jobs. So I'm just leaving being the CEO of a subsidiary of a UK public company, and I'm moving to be the CEO of a transportation company that's backed by private equity. And I think why that's quite interesting is I am here as part of my onboarding the private equity piece and then also the corporate piece. I'm seeing a lot more transaction volume on the private equity side than we do on the corporate side, and I think that's something that we're going to see continue as we move forward into the next year.
Great. Well, thank you, Judith. Next up is Ilona.
Hi guys, Ilona Florence. I'm at C&S Wholesale Grocers. That's kind of the middleman in grocery stores. So for those of you in Boston, if you're buying ice cream at Shaw's or Cheerios at Stop and Shop, that product ran through our warehouses. We're the largest private wholesaler in the country. And, you know, because we've been in the grocery space, we've had a lot of wins this last bit. And in terms of deal flow, it's been a real feast and famine situation. At first, you know, COVID hit, everything screeched to a halt. Deals we'd been working on for years just stopped. Then we heard nothing for months. And then all of a sudden there's this rush, whether it's calendar year, or end of the year, or private deals that are coming to market right now. So it's been very interesting from a corporate development perspective. So nice to meet you all.
Thanks, Ilona. All right, about Matt.
Hey, good morning, everybody. Can you hear me okay? Just want to make sure. I'm Matt Hines from Aon, so I'm a Senior Managing Director in our Transaction Solutions Group. Started my career as an M&A lawyer at Proskauer back in 2003, so I'm a recovering M&A lawyer, worked at AIG. I've actually been through a couple of interesting downturns now in that I arrived at AIG as a rep and warranty insurance underwriter in April of 2008. So 6 months before all the fun started, you know, over there. And obviously have been now with Aon for about 10 years, broking rep warranty insurance, tax insurance, and so forth. It's been a remarkable year, you know, as Ilona just mentioned. I mean, we had a pretty good start, and then everything came to a halting screech for, you know, the 6 months pretty much in the middle of the year. And it's been a slowly building crescendo since then. I mean, we saw, you know, deals start to come back and activity picked up in late June, July. But the activity over the last 8 months or 8 weeks, I would say, has just been unprecedented. And I can't say it's really that surprising necessarily in comparison to 08. I mean, 08 it felt more like we had a broken system and broken debt markets. This was really just a result of folks being forced to stay home and basically being forced to withdraw from the economy for a period of time, you know, for health reasons. And so all of that pent up demand and, dry powder and willingness to do deals has just been unleashed, over the last 8 weeks. So I think we probably could have seen this coming to a certain degree, but I don't know that anyone could have seen it coming at the level that we've seen it over the last month or so.
I would certainly agree with that piece, Matt, that last point on hadn't expected this level. So let's turn to Fred.
Hi, I'm Fred Heller at Nuance. Been involved in about 40 deals over the last 13 years at Nuance. Certainly the COVID impact, since we're mostly in healthcare IT, what we saw is, a number of the companies that we're interested in and some of the segments that we participate in, got actually quite a boost from the COVID effect. And so we saw a lot of, decks in, May, June, July of people sort of saying the COVID bump will continue forever, so they were seeking to capitalize on the go home play and the rise of telehealth and some of the other remote tools. So, and certainly a lot of private equity money, came into play to try to capitalize on those. And so, as we've seen many times over the past, some of the hot money in private equity is hard to compete with on deals, given that their metrics are, very different in terms of how to validate and be comfortable that the deal is going to work out. So that would be my introduction.
Great, thank you, Fred. And last but certainly not least, Jeremy.
Thanks, Janessa. Great to be here today. So Jeremy Siegel. Just joined Progress Software around 6 months ago to head up their corporate development efforts. Prior to that, had spent the previous 21 years also in corporate development at Akamai Technologies and at Logmein. So a long time in the corporate development world in the Boston tech scene. Like Judith, I got my start on the accounting and transaction services side, but at one of the arch rivals, Coopers and Lybrand and PwC, but always psyched to spend time with fellow accountants and transaction services folks. I'd say that, for us, very similar themes to what you've heard before. I think that, we saw a real slowdown. A lot of the inbounds that were coming early in the year, really a lot of those shut down, but we're starting to see a definite pickup in the inbound activity for sure. And I'd say that, the one thing that's interesting for us is we were able to complete our first transaction start to finish entirely virtual. Which was something that I was a little reticent whether or not it was something we could do. But getting adjusted to the new world order was something that we spent a lot of time thinking through, and super excited about the success of that transaction so far, and now experiencing an integration of that acquisition again 100% virtually. So look forward to spending more time talking about that as well. But excited to be here today.
Great. Well, thank you, Jeremy. So I am definitely going to touch on that. So kudos to you and the team for actually doing the full deal, soup to nuts on that. That I'm sure was not an easy feat. So, but let's just start a little bit more broadly. And how have you seen? Each of you have kind of given your initial comments on kind of how the pandemic over the last say year has gone up and down, and there's been quite a bit of volatility. Have you seen the appetite for deals change, and are deals getting done?
Yeah, I guess I can start on that one, and I would say certainly early in the year when COVID first hit, there was definitely a shutdown. I think people needed to assess and sort of see what this was going to be and whether or not deals could actually get done in this type of environment. But I think that, and it was also a great opportunity for VCs and private equity firms to really sort of take a step back and look at their portfolio companies and think about which ones were ones that they wanted to continue to double down on, and which were ones that maybe they had seen their course and wanted to explore exit type opportunities. That's one of the reasons why the opportunity with Chef actually fell nicely into our hands. It was an asset that had a really good scale, but wasn't necessarily growing at the rate that the VCs would like to see of their sort of star performers. And so it was an opportunity for us to come in and do an acquisition there. And I think that we're definitely spending a bunch more time working with that VC community, working with that growth equity and PE community to sort of understand who in their portfolio might be more ripe for liquidation at this point. And so we think that it's creating a lot of additional pipeline and opportunity for us, which is exciting. And I think a couple of the panelists mentioned that they're seeing a lot more activity from the PE side. I think that that's something that we have definitely seen. I think as in the past, when strategics had more of an advantage because we could pay more because we could get more synergy, I think that we're seeing that the PEs are being equally competitive. And the other piece that's interesting is that there's sometimes a greater emphasis on certainty to close than valuation, and certainly from a certainty to close standpoint, PEs have that advantage over a public company, like someone like a Progress that is not necessarily going to have the same kind of leeway and flexibility that a PE or a PE-backed strategic might have. And certainly to Matt's world, we are needing to become more flexible. We did use rep and warranty insurance for the first time in Progress's M&A history in order to be competitive in the chef acquisition. So we know that things like that are becoming more and more important in order for us to play in some of these opportunities. And certainly, as you've seen with some of the bigger transactions recently, I think clearly the appetite for doing deals is there. The appetite from Progress's perspective, where our growth is primarily driven from inorganic, is going to continue to be there for sure.
Yeah, no, I think I had heard I don't know, when it was in the last few days, you mentioned the PE folks kind of being a challenger, being, definitely very active in something like $2 trillion of cash that they need to put to use. So I'm sure that is, they need to get going on that, especially in 2021. So I'm sure it's an extra headwind for folks like yourselves in corporate. So
for sure, and it's a lot easier for them to backstop deals than it is for us to necessarily go into the capital markets at times when there's still some uncertainty. So it definitely puts them at an advantage.
Yeah. So maybe I'm going to turn to Alona now, and Jeremy, you had mentioned the certainty to close versus valuation. Alona, are you seeing any evidence of a reduction in valuations in multiples as kind of folks had predicted, or kind of what's your take there?
Yeah, I think we're a little influenced by the industry we're in, and grocery is in this unique situation where they're having the benefit of better earnings than they've ever expected. So the sellers who are coming to market, they are trying to capitalize on that COVID bump. And I wanted to touch on Fred's point in your introduction. The books and the sell processes where they try to presume that COVID's going to continue forever, it just makes you think in your head as a buyer that it really discounts the credibility of the process, because nobody thinks that COVID's going to last forever. We're not all going to eat at grocery stores forever. We're tired of our own cooking, right? And I think in my head, when I look at processes, my head's in 2019. I look at the EBITDA of 2019. I think of the multiples back then. I'm not thinking that even though they're seeing these kind of pickups now, that it's going to last. And so that valuation is very tricky, because I think sellers think they've got something good. Buyers think this is just a moment in time.
Yeah, I would definitely say I'm not a master in the kitchen yet, so definitely excited to get back to restaurants. But I think certainly on the sitting where we sit, that's definitely been the case around COVID and the ad backs and kind of the extra bumps. So very, very interesting point there.
Oh, can I add one more thing? Jeremy,
Sure.
The rep and warranty insurance thing, and Matthew, that is a huge deal now. I feel like deals don't get done if you don't do R&W.
Yeah, and I think that
my ears, frankly.
Yeah, but the challenge is, and I'm curious to get your perspective on this, is whether or not it is the sole recourse that you have, because that piece is a little bit challenging and a little bit more discomforting for a public company. And on the multiple piece, the funny anecdote that I'll have there is when I joined Progress, I think my CEO, his expectation was that multiples would certainly compress as a result of COVID. And I will say, 100%, maybe it's just in the space that we play in DevOps and infrastructure software, we have not seen that. The multiples have stayed strong. if anything, they have improved, and so or increased, and so that's made it a little bit challenging. So certainly, something that we expected would potentially come out of COVID hasn't necessarily played out as we anticipated on the multiple side.
What about anybody else?
Just to follow up on your point on rep and warranty insurance. I mean, that's obviously my bread and butter and what I do. And you're right that it's pretty much a mainstay of the marketplace now. I mean, when I joined Aon in 2010, we did about 30 deals. Last year, we did 730 deals. So we think we're about a third of the market. So if you extrapolate that out, you're talking about a pool of deals that ranges from 2,400 to 2,600 M&A transactions annually now that have rep and warranty insurance as either partial recourse or, Jeremy, to your point, full recourse, where the seller's got no indemnification obligation whatsoever, and the entire path to recovery is kicked to the insurance market. So it has changed, I think, fundamentally the way folks think about many of the aspects of doing deals, including valuation pieces, right? So I mean, when we place a policy and loss tied to that policy, we're typically getting some measure of recovery for diminution in value theory of claim, and that will be tied to obviously whatever multiple we're paying, and tied to the LTM EBITDA, and we're getting to a place where we've seen multiples at some point get so high that carriers are saying we can provide the broadest coverage possible and provide coverage without any limitation on diminution in value or multiplied damages theories of loss. But if you're paying a 17 or 18 times multiple because that's what the market's going to bear, I'm not sure I can cover you at that rate. So what you're seeing in the corp dev world and the valuations and the multiples that you're seeing start to percolate do have impact on some of the terms that we're actually seeing in the insurance world, as well as we're supporting efficiency of transactions.
I would just chime on the valuation part, though, that if you were a business that had a negative effect from COVID, unless, as Jeremy was saying, it's a kind of a point in time for somebody to reevaluate their portfolio, you'll just, why go to market then if you don't, need to? So it's natural to see that those are capitalizing on the apparent good news in the market and maybe overstating its ability to repeat. And obviously, if you were, in fact, knocked backwards a bit, you would just wait.
Yeah, though, Fred, I've also seen just a little bit on some of the smaller owner-managed businesses just wanting to get rid of risk. So those that have been really adversely affected by COVID are maybe taking a smaller multiple on their 2019 numbers because they realised they were basically in a situation where they were having to fund things during 2020, and they know if they have to go through that again, they're not going to have the ability to do it, and they feel as if there's no certainty that the government will step in and support if there's a second turn. So they're quite happy to get rid of the risk and love people like private equity for buyers because it allows them to still have an ownership stake and be part of it in the future, but without having the same level of risk. So I think there is a population where I think the multiples are lower, but it tends to be that they've got another item that they're wanting to achieve, rather than just maximise the money that they're getting.
That's a great point, Judith. Fred, I'm going to come back to you. So just on this point, Judith had mentioned, some of the smaller business owners are trying to de-risk. What are some of the other, things or implications that business owners are having to consider, as they enter into sale processes?
I mean, I think it is the certainty, as Jeremy said, it's the usual set of stuff that people are trying to take advantage of a positive environment. So kind of somewhat, we didn't all expect there to be such a positive environment at this point in the COVID process. But that's what we have for some segments. And so people are just, trying to take advantage of it, trying to make sure that they don't have escrow problems using reps and warranty insurance. So I think, the owners are doing what you would expect them to do. Certainly one of the items that people are not yet talking about a lot, but certainly we've had in the past when there was tax changes that were coming. There's this question of whether or not, for those where tax consequences are important, whether or not this year would have been a better year to sell than next year, whether or not next year is a good year to sell. versus the year after, because the concerns about tax hikes and handicapping that, does make a difference to some sellers. So, but we haven't seen that come up yet. Right now, the companies that we're dealing with tend to feel like they're riding a great trend. They're basically taking the attitude, for good reason, of, gee, we're getting all this inbound interest from all these private equity firms. And so, we're kind of, should we do that Series A, Series B, Series C? Or, or is there a strategic that wants to take this opportunity to take us out? So certainly seeing a lot of that play going on more than usual. Everyone's always trying to create a real or perceived bidding war environment when they're going to market. And, sometimes it's right, sometimes it's wrong, but certainly the hot money in private equity, makes that more credible. We've been in situations over the last several years where, that was part of the environment, and it was, in fact, later on we could verify that it was true. You always wonder a little bit when you're being told that it's true, and it's always comforting to know that you weren't hoodwinked on such points.
Good. Well, so I'm going to maybe turn to Judith here and ask what are some of the advantages of conducting M&A? And it's not really a downturn, because Fred, as you just said, it's almost counterintuitive that actually there are a lot of bright spots. So what are some of the advantages? Maybe we don't talk about this downturn because this is more or less it's kind of the opposite. But in prior downturns, what were some of the advantages of kind of conducting M&A?
Yeah, well, I'll talk a little bit about prior downturns, Janessa, and this one as well. But I think I'd say a lot of it's industry specific. So depending on what industry you're in, makes a big difference as to where you are. Because I think we're talking about the grocery trade earlier, and I also know a lawyer who does a lot of work in the utilities market, and that's basically the last place where people stop paying their bills. So there's always going to be the ability there. I think that there is less competition, because there are some companies who have just decided that they have to put M&A on hold. You tend to see that's more of the corporate side who took government funding. So if they've stopped dividends and they've taken government funding, for them to then go out and buy other companies doesn't work. So it does open the playing field a little bit more to others, but that can actually lead to actually more competition if you've only got 2 or 3 people going after it rather than more. You almost know who it is you're going up against, and people's personal competitive spirit kicks in there. I think what's actually quite interesting in this one is it's changed the fact we've had to move virtual. So everybody thought that was there's no way we can do transactions in a virtual world, that isn't going to work. But I'd actually argue it. I actually think you get to know people a little bit better when it's when everything's done virtual than you did when you only got the opportunity to maybe, okay, we're going to meet this week and it'll be another month before we have an in-person meeting. It's almost every day you're on some sort of Zoom or Microsoft Teams, and everybody's let their guard down. You see sort of people's background in pictures. You see people a little bit more with their environment, and people are happy for their dogs and kids to be involved. So I think it's actually going to make some of the integrations a little bit easier as you go forward, because the principals are interacting a lot more than I've seen in the past. So it does make it an interesting time, and I do think there are bargains out there that if people are, as I mentioned before, wanting to get out of the risk. But it is really, I think, surprised everybody how hot the market is and how much multiples are holding up, if not increasing.
Well, maybe we learned our lessons from the couple of economic downturns we had the beginning of this century. So to one of your points, Judith, maybe I'm going to turn to Jeremy, since he's got the real life experience of actually doing the integration.
Yeah. Well, yeah, no, I was just jotting down a note because I think Judith made a really good point there. I mean, I think we were able to be a lot more efficient through the diligence process because of the fact that we didn't have to worry about coordinating different travel schedules, because it was a lot easier to hop on a Zoom than to figure out when the next time was that we could all get to Seattle. I think you lose some of that personal aspect that, certainly in my 21 years of doing this, I cherish, getting to know people, having dinner with them, having lunch with them, whatever it is, and that more personal interaction. You don't get some of that for sure. But to Judith's point, I mean, you definitely get to know these people pretty well and get to know like what their families are like what the CEO of Chef was living on a houseboat on the water there in Seattle, and great stories around that probably wouldn't have even known about if we were going through a regular process. So you do get to know these folks a little bit better. I think where I was most concerned about it was on the integration side, because on the integration side there's so much importance placed on the personal interaction, and having the opportunity for each of the employees to sit down with the IT specialist, to sit down with the HR specialist, some of those things that you weren't able to necessarily provide. But we got creative, and we had lots of virtual office hours for HR and IT folks. We did one-on-ones with every single employee at the company, which was something that they really, really appreciated. That was over 250 employees, so it was quite the lift in a 3-week time period between sign and close. But I think it forces you to just sort of think more creatively. But I mean, having gone through it now, I have a lot more confidence in our ability to be able to continue doing deals if we continue to be in this position where we can't travel and we can't go to these companies and sit down with them face to face. And to Judith's point, still get the same personal interaction, really get a feel for the culture and things like that without necessarily being present on the floor in the boardroom or wherever it might be. So
yeah, we're living with some of that right now. We're between sign and close on this divestment that we announced recently. And usually in this integration process between sign and close, you have everyone coming into a location. You send people to breakout rooms, they do stuff, they come back together, and you can really control people's time for a day or two to have that intensity that's both personal as well as no other distraction. So that's the other part of the video effect is you schedule meetings, but you don't have that same ability to control people in a physical environment, which is a usual accelerant to these integration processes. And so we're having to deal with that. But at the same time, people can easily make additional meetings, and things can kind of go on and on. You don't have the limitation then of, okay, we're all flying into Chicago for a day or two. It's more continuous, but we're definitely living through that right now from the divestment side.
And hopefully, as you kind of get through that, if you do get to that positive point, and you kind of look to the future. I mean, right now we're all pretty much sitting in our own homes where we're not having those personal connections, even with our family and our close friends. So, and those connections are still living on and doing quite well. So, I mean, hopefully the same extends to transactions in the business world here. So, well, that's all good to hear, Fred, that, although there's been some distractions, things are still going well, and same for you, Jeremy.
Yeah, and one of Fred's former colleagues stressed this to me, is he was one of the first people to announce a deal start to finish in a virtual setting. Just the importance of over communication. Couldn't reiterate that enough. And we saw that. We had weekly newsletters, weekly emails, sort of providing as much transparency as we could throughout the process. And I think that the target companies appreciate that because it just gives them more visibility into what's going on in a time period of a lot of uncertainty. And
that piece on over communication, it's almost, it should be a tenet anyways. It's just extra important in this environment. So hopefully another bright spot that comes out of this, and folks kind of grab onto that moving forward. So, all right, I'm gonna turn gears a little bit to a little bit more of the hot topic from the month of November. And Matt, I want to kind of pose this question to you. As you kind of look forward, what do you expect, or how do you expect future tax reform and regulatory changes and everything that's kind of shook up right now in our political system? How do you expect that
Sure.
to impact M&A?
Have things been shaken up? I didn't realize that.
No, not at all.
Yeah, it hadn't impacted me yet. So I think there's a couple of things, and rather than try to look into a crystal ball, I could give you a sense of the things that we think about, and what's going to impact our business. We're inextricably tied to overall M&A activity in what we do. So on the tax front, certainly right now, you're obviously seeing a mass of deals coming to market and hoping to close within the next 3 weeks to avoid any potential increase in tax next year. That would presumably be somewhat dependent upon what's going on in Georgia and the runoff elections down in Georgia. So we still are seeing, in fact, I've been mildly distracted here because we're literally having deals come in as I'm sitting on this call with you to try to get in and get under the wire before year end. So that's certainly a near-term impact of tax uncertainty. Longer term, I think it's going to be one of the interesting things that we're watching, and we'll love to see how it plays out. Is we've talked a lot about private equity today. Change to the carry tax structure right now, and how funds look at structuring deals going forward if carried interest at some point is taxed at ordinary income rates as opposed to cap gains rates. How's that going to change the private equity model, and how's that going to change their approach to deals? And also, how is that going to change talent, right? Top students and top potential candidates for jobs going to start to look a little bit less closely at private equity jobs because they may be less lucrative at some point with a much higher tax load to bear. That's going to have pretty wide-ranging ramifications, I think, if we do see some modification there. In terms of trade and regulation, we've seen a ton more international business over the past few years. And again, I run our rep warranty insurance and tax insurance group with a partner of mine. And we've done cross-border deals for a long time. We've seen far more cross-border activity over the past few years, which has been, I think, great for everybody. But we've almost had this, I don't know if schizophrenic is the right word. We've alternatively tried to invite foreign investment through, a lower tax rate regime in the U.S. while simultaneously kind of giving the stiff arm through, regulation and, trade wars and increased tariffs. Maybe getting some semblance of, consistency there over time, and perhaps a broader regulatory framework that is perhaps tied together a little bit more cohesively might invite some more of that, broader international investment and increase in cross-border activity for us. The other thing is, we've just talked about it. We're all sitting here on Zoom calls constantly. The ability to work remotely and, the increasing digitization of the economy, we're looking at, LATAM, far more activity down there, and U.S. investment, European investment into Latin America, I think is facilitated by everything that we just talked about, as well as emerging markets, for investment in Africa and some other regions that before were not necessarily at the top of folks' list in terms of long-term accretive investment. Now it's going to become quite a bit more viable. Just given the way we all do work, as everyone just talked about, and the ability to do work not having to sit in a room together. Lastly, the one other interesting thing that we saw this year, and this isn't necessarily a regulatory or tax change over time, but and we talked a little bit before about the intersection of private equity and capital markets. I think over time, the amount of private equity interest in pipes that we saw earlier this year was really fascinating to us, and we saw some folks approach us about potentially placing insurance on those deals from a rep warranty perspective. Where you traditionally would not see that. Obviously, when I think we're probably in for a relatively bumpy ride for a while from an equity market perspective and equity valuations. Things have just, vastly, I don't know if it's a matter of, trading platforms or what, but, things are so much more volatile and the swings are so wide now that any sort of decrease in, broader equity market valuations, I think will lead to more private equity interest in trying to invest in pipes and trying to take a piece of those investments where there's a dearth of or a lack of platform investments available as there were earlier this year. I think that brief moment in time, I don't know if it was fleeting or not, but I think that piqued the interest of a lot of private equity funds in looking to the pipe market and potential capital market investments as an alternative to a new platform investment, where you may not have, really viable or attractive opportunities sitting on your desk and a bunch of books, sitting on your desk that you want to invest in. I think it's kind of widened the aperture of some of those folks. So all in all, I mean, look, turmoil breeds innovation and opportunity, and I think we've seen more than enough turmoil this year. I think all of these things are kind of, coming out of that and will play into, what we've seen over the past 12 months going forward for the next 2 or 3 years.
Thanks, Matt. I'm sure I absolutely agree with you that we've certainly experienced a lot of turmoil this year, and I'm sure many of us will be interested to see how the January Georgia races play out. So.
Right.
So maybe we leave that the tax and politics off the table, and we move to other maybe more exciting topics. I want to Judith talked a little bit about the prior economic crises. So maybe I want to step away from COVID a little bit. I mean, of course, if there's a COVID related impact to it, but and any of you can jump in on this, but what are some of the other changes, whether macro, micro, that have occurred over the past 5-10 years in the M&A process that you've seen? I mean, of course, we've seen, all living in the remote environment, but what other things, whether it's on the buy or sell side or integration side, what's changed in the dynamics over the last 5-10 years for you all? Well, there's been some change.
Was that a general question?
Yeah, general. Any of you, if anybody wants to jump in.
I mean, I guess certainly we've talked about props and warranties. That's sort of zoomed in quickly. I think the role, frankly, of the financial diligence players as a substitute in some cases for diligence for some players. I mean, it's one of the reasons I think that we've seen so much of the certainty for close for private equity, because private equity walks in and says, yeah, we'll just have a couple experts and we'll hire one of the big firms to do some diligence, and that's good enough for us. And so, that change really in the diligence process for the private equities then has added pressure to everyone else on what used to be, and I think still for us is, because it's hard to shake these habits, because we're going to live with the company. So we are very intent on doing very thorough diligence, and always have and always will. But it is then this certainty of close issue where sellers are sometimes saying, yeah, we like the private equity guys because not only the decision making is clear, and but we understand the Q of E deck that we have to present, and then we have a few meetings and a few experts, and then boom, we're done. Whereas strategics, I don't think we're alone in this. Strategics tend to have more stakeholders with more agency effects in terms of what is this acquisition going to be to me? Like, am I really going to be? I have to raise my hand in front of the CEO and say that I'm happy with this deal. And so, we take it, frankly, what I can say, more seriously. And so the effect of the private equity firms and the use of external players has increased, and that adds pressure on certainty of close and the rise of rep and warranty insurance as a part of that.
Yeah, I would sort of build on that point, Fred, because I think you're spot on. And we were in another situation recently where we didn't win the auction process, and we didn't win that auction process because our diligence process was so much more thorough, was so much more in depth, and we were asking so many more questions. It sort of raised concerns about our ability to have continuous diligence once we got to the next stage, and what that was going to look like, and also how challenging we'd be from a negotiation standpoint on just the definitive agreement versus this other company who was PE backed and basically submitted a marked up seller friendly agreement with minimal markup, and that's just not something that we or Fred as public companies can do. And so it goes back to this whole point I made earlier on the PE side. They're just so much more. There's so much more present, and they're doing so much more in software now. And because Janessa, of your point about they have $2 trillion plus to put to work, they can make bets and miss on a few much more freely and easily than any of us on the corp dev side, particularly corp dev public company side, can do. We make a bet and it's the wrong bet, and our stock is crushed, and the activists are pounding on our door. So we can't afford that. But then at the same time, how do we remain competitive? So it's like striking that right balance. So it's definitely gotten more challenging.
Fred, your point about the use of outside advisors is really interesting as well. Because, I mean, again, we see quite a lot of deals, we work on a lot of deals. The pace of deals, obviously has changed quite a bit. And when you talk about a strategic or corporate buying element in those deals, and folks internally who are doing the diligence while also having a day job, whether in finance or HR or tax, treasury, whatever it might be, the ability of the funds, as you said, to fully outsource the vast majority of that work and receive reports back in 7 days or 2 weeks without having to focus on other obligations internally and other obligations to the enterprise, to the firm, completely different animal, right? And we move now, we could get a deal done over the course of a weekend. And it's just remarkable compared to, when I started, close to 20 years ago. So completely different. The other thing that I would say is, and to move away from rep warranty insurance, although I'm happy to talk about it all day, we as a firm are focusing on intellectual property quite a bit as well, and just, the overall pivot and, across corporate American balance sheets from tangible assets to intangible assets. And, basically a flip, an 80-20 flip from, 20% intangible, 80% tangible 30 years ago, to now 80% of corporate America balance sheets are intangible assets. Some of that is goodwill, but a lot of it is tied up in intellectual property. And we're doing a ton of work to try to figure out how to effectively value that for clients, predict or potential risk or liabilities associated with a pool of intellectual property assets. But also when we do that, and when we can value it and sort of ring fence the risk around a portfolio of IP, can we then insure against that? Or can we use that if we can do some sort of residual value insurance against that pool of IP? Can you then borrow against that more effectively? Which certainly would help, I think, at the corporate level, but certainly will help at startup level where you've got revenue, pre-profit companies where their only asset or majority asset is the IP they've developed, rather than doing a CD or E round where they're giving away equity and upside. Can you now tap a debt market that might not have been available before, using your IP as a more prevalent part of the collateral base? So tons of interesting stuff coming out of that side as well.
I can certainly say on the diligence advisor side, it's definitely, I can attest to all the statements around trying to get things done quicker and really focused and pointed, and as opposed to back in the day, it was started in this, and it was it'd take 3-4 weeks, and you'd kind of go through everything and anything and everything, and now it's much more pointed diligence, very data heavy driven analyses. So a little bit, definitely that switch mindset is everything is more based on data, and as opposed to just looking at your standard P&L and balance sheet from a higher level. So that's certainly from our side one thing that we've seen. And Fred, to your point, it's shorter time and definitely very pointed, as opposed to looking at everything. So
can I add one thing?
Yeah.
I would add that something that's evolved with us is we're accelerating tax diligence to the front of the transaction, just because we were running into issues where, like, towards the end of the deal, you'd have all these hairy tax issues and things could blow up. And I think, talking about the advisors, we really want to start getting advisors up front, working on some of the hairy issues so you can kind of address them on the front end of the deal. And I think that goes to the acceleration questions, making sure the seller knows exactly what issues you have so you're not surprising them towards the end. But then there's that balance that Jeremy mentioned where you do a lot of diligence. We do a lot of diligence too. And it's amazing. I don't know how PE firms get away with it, but they don't have to do that much. And so it does pose a challenge. So
I'm sure my tax colleagues would love to hear that. Accelerating your tax diligence.
We also sell tax insurance. So we can help with that too.
It's an advertisement.
There you go. Well, I know we only have about 10 minutes left, so I'm cognizant of the fact that we want to also see if the audience has any thoughts or comments for us, or questions. So Mari, I'm going to turn it to you to let us know if there's anyone from the audience that has a question.
Okay. If anybody has a question they have for the panelists, just click on the participants list, and right next to your name there will be a hand. Just click on that little hand and that'll let us know you have a question. Don't be shy. I don't see any questions so far.
All right. Well, I think maybe we'll kind of keep going, and if somebody chimes in, then we'll turn back to you or let us know. So
Okay.
one question I wanted to ask is, and I think Jeremy, you had a deal getting done. Fred, you're close to getting that deal done. There's that statistic that, more than 80% of deals ultimately fail. Certainly in your cases, maybe that's not the case right on those deals, but has that changed during the COVID environment since we've seen this, real swing in, from late summer till now? Are more deals getting done, less deals getting done? What are you guys seeing or experiencing?
I mean, certainly from my perspective, I'm just seeing more and more activity, more and more activity from the bankers, more and more announcements getting done. I mean, certainly, from our perspective at Progress, we don't anticipate any slowdown. M&A is a key strategic pillar of the company, so we're going to continue moving forward on it. We're not really focused on sort of earlier stage, riskier companies where we're hoping that 2-3 years down the road they generate some revenue. We're definitely focused on businesses that have scale, have a proven track record, have a core set of customers that are loyal with a nice stream of recurring revenue and high net retention rates. To the question that was asked on the poll, the work that you guys do on analyzing net retention, ARR, and really helping us understand trends there is huge for us. But we're looking because we're looking at more established companies, and I don't anticipate any slowdown in the near future from our perspective. And I think you're seeing it in the IPO market too. I mean, that's continued to thrive, and so I think it will just continue to. People are moving forward and figuring out how to do it and get it done.
Yeah, I was just going to say, I think you see a lot of the companies that are coming out at the moment are ones who truly want a transaction to happen. I think some of those people who speculatively come to market just to see what their valuation might be are seeing COVID as not the right time to do that. I still think you get a few that have that COVID bump that people have said they've seen books coming out with and wanting to maintain that. But I also think there's those who know that COVID was problematic for them, have decided they're probably better to wait a little bit before coming to market.
Yeah, maybe doing some in-house kind of cleanup or kind of
Yep.
before they go back to market maybe in 2021. So maybe that takes us to our final question of the panel today. Putting all our future thoughts, future perspectives on the line here. I'm going to have each of you kind of, maybe we'll start back with Judith. Answer and provide your last parting words or perspectives on kind of going forward. What do you anticipate from an M&A perspective, whether it's at your company specifically or more broader in the general market? But how do you see M&A taking shape and form in 2021? And is it the mega deals, tuck-ins, transformational M&A? What do you guys see? So maybe Judith, we'll start with you.
Sure. Look, I think from my perspective, still think we're going to see transaction volume being really high next year. I think you'll see a lot of tuck-ins and consolidations happening. I'm not really in the space where we're looking for anything that's transformational. I think we'll see the trend of doing things virtually, even when we're allowed to travel again. I think we'll still keep a lot of that. I think we'll bring a little bit more of the sort of dinners and personal interaction back, but I think a lot of the diligence. I don't think you'll see KPMG teams jumping on planes to go do diligence in person that much anymore. I think we'll see a continuation of rep and warranty, and I think what we'll see is a shortening of the time period between something initially coming on market and closing. I think you've seen that kind of condense, and I think that's going to continue because there's money out there to be spent. So those who have the money, who want to do the deals, are wanting to do multiple deals because they feel as if there's that window of opportunity that they've got.
Great, thanks, Judith. Alona, why don't you go next?
Sure. I was thinking back on this COVID year, and it really showed the vulnerability of supply chains. And I think when I think about what kind of deals are we going to go after, there's obviously the consolidation, trying to get bigger and better because you're going to be able to manage any volatility in case COVID resurges. And I think there's going to be this factor of deals that are all about, it's not a synergy play, it's not an ROI play, it's I got to get automated and digital because I need to. And I think I'm going to be more open-minded to access that capability because I know that the future is going that way, and I can't articulate to you what I'm going to do for synergies, but I know that I got to get hands out of stores. I know I got to get my trucks on the road that have less contact just in case something like this happens, because it was a just-in-time supply chain, and it really took a lot of people back. And so that factor of deals, I think, is going to play a part with a lot of players.
Well, thank you, Alona, and certainly I'm glad to see toilet paper and paper towels back on the shelves.
They're not totally back, but they're almost there.
Almost. At least they're there. All right. How about Matt?
Well, that was a fascinating comment. So I mentioned before I practiced the cross-scour back in the day, but Shay Wong, the CEO at Box.com, was a fellow cross-scour alum of mine. We worked together back in the day, and I've heard him talk about that same exact thing on CNBC, and I think that's a really sort of prescient thought about where everything is going, particularly after the last 6 months. Right, it's really made it much more imperative for everybody to consider. I am not looking past the next 6 months right now. Frankly, I'm not looking past the next 6 hours, but my suspicion is we're going to see a pretty good breather in Q1. I think folks are going to honestly take a breath, and while the administration shakes out, we get a little bit more window into legislative imperatives next year. Given the activity that we've seen, I just don't know that we can keep up a pace like this for longer than a quarter or two at a time. I think there will be a little bit of a breather, and people will take a step back. We won't have that impending tax sort of Damocles potentially hanging over our head that we're looking at now as of 12/31. So my suspicion is it's going to be a little bit slower in Q1, not because of lack of interest, just because people will need to to take a breath. But then fully expect Q2 and on out for things just to continue onward and upward. I mean, I don't see any impediment to deal making and robust M&A activity at all. So.
Great, thanks, Matt. Fred.
I guess the question mark from a long-term perspective I have, we've been sort of in a 12-plus year bull market for equities in general, and COVID was like a 2-month break. So even at its worst in March, we lost 6 months or something of the value of a 12-year bull market, and so that bull market in equities that has put so much money into the hands of private equity and the very low interest rates have made this artificial environment that always looks like it's going to continue until it doesn't. So that's the thing that's looking forward a year or two. I mean, in general, I'm an optimist, and I think that, all things good and no reason to not worry, but cycles are cycles. And there is this notion of, cycles do come to an end, and that will have an impact. So, we'll ripple through certainly the M&A as people, lose confidence in their ability to forecast and their ability to get easy money from PE, et cetera. So that's the thing that's very hard to predict. It's the thing about the future. It's hard to predict. But, cycles, it's no question that we are, by any historical process, in the late stages of a usual bull cycle. It feels good, but it does make one worry.
It definitely does, but hopefully we can continue this ride and keep it going and improve cycles otherwise, or make it just an elongated cycle for us all. And last, Jeremy.
Well, I think I think a lot of the points were already hit on, and certainly, from our perspective, we anticipate there being a continued opportunity. I think that, to one of the points I made earlier, I think that some of the VCs were maybe reticent to explore liquidity with some of their assets and giving them a little bit more time. But I think 2-3 more quarters of sort of evaluating their portfolios, I think there's going to be another batch of those types of companies that are going to become available. And so I think that's going to continue to create opportunity, particularly for buyers like us who, have deep pockets and have that strong balance sheet and have that bigger platform for being able to go to the next level for some of these other companies.
Great. Well, thank you all. Really appreciate all of our panelists joining us today and sharing their perspectives. I, for one, found this to be very exciting and great conversation. So thank you all and have a great rest of the day. Mario, I'll turn it back over to you.